Hi folks, welcome to this video which gets us to prepare a consolidated income statement as well as calculate some consolidated balances, specifically retained earnings at the end of a year. Now this question is a little bit different in that it also includes intercompany sales of inventory, and it also includes an intercompany sale of a depreciable fixed asset. Now, we know that in order to do the consolidated income statement, we have to figure out what all of the expenses would be, and part of the costs that would be included there would be any impairment losses on goodwill. So the first thing we're going to do is to calculate goodwill. Now, you know our process would be to start with what it cost us to buy our 70% interest in the sub, which is Dandy, and we say that's $7,000. But we want to look at it from the perspective of, well, even though it only cost us $7,000, we do control 100%. So what's the implied value of what it costs us to control it, and that's $10,000. We're going to compare that to the book value of net assets of Dandy, the sub. So we're going to look at its common shares and retained earnings, because that's assets less liabilities, which is their net equity or net assets. We get this from the question that at the date they became related, common shares were $250 and retained earnings were $4,500. So now we know our acquisition differential is $5,250. So why did we pay why do we have an acquisition differential of $5,250? Well, in part, we saw an increment in the inventory. We thought the inventory was worth $100 more, and we thought the equipment was worth $500 more. And that accounts for $600 of the $5,250 acquisition differential. So that means we have goodwill of $4,650. The next step in the process would be to do a schedule to show the acquisition of the acquisition differential amortization, including any impairment losses. So I'm just going to scroll down here a bit and show you the amortization schedule, which amortizes the acquisition differential. Again, we know we had 100 for the inventory. And don't forget, I put here the date we became related. Sometimes students get the wrong date here or the wrong years here. Don't forget, because they became related right at January 1, you have to consider in your amortization a full first year, which begins in year 1, all the way to the end of year 5. And again, remember, we're going to the end of year 5 because we're doing statements for year 6. So anything that's going to impact our retained earnings would be happening from years 1 to 5, and anything in year 6 would impact income. So because we have to calculate the two balances, it's very advisable that you separate out the post-acquisition acquisition differential amortization amounts that have been accumulating from the beginning of the date we became related to the end of the year that precedes the year that we're doing the statements for. In our case, that would be years 1 to 5, right? And we know that inventory would have well turned over by that time, so we would have amortized the increment, had nothing to amortize in year 6, so we'd have nothing unamortized. We know the equipment has a 10-year life. That's given to us in the question. So we would amortize 500 divided by 10, which is $50 a year. In our case, over the first 5 years is $250, and in the current year, $50. So that's going to leave us with an amount that's unamortized of $200, and our goodwill was tested for impairment. Now the question gave this to you in an odd way. It said for you to assume that by the time you got to the end of year 5, that the recoverable amount was $1,100. So that means $4,650 less $1,100, which is left, means that we must have impaired or tested and got impairment from years 1 to 5 of $3,550. We also know that by the time we get to the end of year 6, the recoverable amount is $1,030. So if we had a recoverable amount to the end of year 5 of $1,110, and now it's $1,030, then that means we'd have 70 left, 70 that we calculated an impairment of for year 6. So that would leave us with what we said we would need, which is $1,030 at the end of year 6 as recoverable goodwill. So now we can see the adjustment to our consolidated retained earnings balance. We can see our adjustment to the subs income when we calculate consolidated consolidated net income, and this amount is going to be in part allocated to NCI. Now in our question, I don't believe we have to calculate any NCI, but it's just good that you know that. Now, if we go to the next step we would do before we can calculate any consolidated net income, we should probably have a look at all of the intercompany transactions. And you'll know that the format we use is to look at before tax, tax, and after tax. Because these intercompany profits are going to have an effect on income. So we want to know the pre-tax effect on income, the income tax expense effect, and our after-tax or effect on net income. So let's begin. So now we notice that in opening inventory, the sub was selling to the parent. In fact, if you notice, with all of your inventory, there was no selling from the parent to the sub. It was all from the sub to the parent. That's with the inventory. So in the previous year, year 5, we had opening inventory profit when the sub Dandy was selling. And left in that part of that opening inventory, it included $2,000 from that intercompany sale. Well, what's going to happen now is that in year 6, we would do a profit shift, right? Remember, we talked about that in class. So we would take into pre-tax income $800 in year 6, because if this was based on a year 5 sale from Dandy to Handy, our parent, then that means that by the time we got to the end of year 5, that $2,000 is the amount that the parent purchased from the sub that it couldn't sell outside. But by the time we got to the end of year 6, it's a current asset. It would have been sold outside. So in this particular year, once that inventory is sold to an outside third party, at that point in time, we can now start to recognize the profit on it in year 6 when it's sold to a third party outside. So now we're going to recognize $800 pre-tax, $320 in income tax expense, and we're going to adjust our opening balance of retained earnings by $480. If you're not sure about this, you'll remember we did some eliminating entries on the working paper to show you that we would reduce our opening balance of retained earnings so that we could shift the profit pre-tax into income and book our income tax expense on it. So when this $800 gets booked into income, that's when we can book the tax expense. And don't forget, in order to book the pre-tax profit, what do? We reduce the cost of goods sold. So if you think about it from an income calculation perspective, whenever you reduce an expense, what does that do? It increases income. And in this case, pre-tax income, it's cost of goods sold. So therefore, we want to recognize that $800 profit. So we would make a working paper entry to reduce the cost of goods sold by $800, I should say. Book 40% income tax and adjust downward our opening balance of retained earnings, okay, because that's when the sub would have booked the profit, okay, but we want to shift that profit so that it hits our ending retained earnings for year 6 on the consolidation side. So that's our adjustment. So in our case, going back to our schedule, we also have closing inventory. So during the year, the current year, Dandy also sold some inventory to Handy, and the parent, Handy, couldn't unload $2,500 of it. So we know there's a 40% profit in there. So our profit before tax is $1,000 that needs to be eliminated from year 6 income. We say eliminated because this won't be sold outside until the following year, year 7. But for now, the consolidated entity can't recognize it because the parent still has it at the end of year 6. On that, we would calculate $400 in tax expense. So we would need to make a working paper entry to acknowledge that we have to remove from net income, our calculation of consolidated net income, $600 in after-tax profit. So if we were to do that, just to remind you of what those entries would look like, we would have to remove the profit and adjust the inventory downward because it's the inventory that's holding the profit. Well, we've calculated the pre-tax profit at $1,000. So when we adjust inventory, we normally adjust that to cost of goods sold. And that debit to cost of goods sold would actually be increasing expense, which would do what? Reduce income, which is what we want this year. We want to reduce our pre-tax income, and when we do that, we're going to reduce our tax expense by 40% of that reduction, which is $400. Now, don't forget, we set up a deferred tax asset here. Why? Because the company, sub Dandy, who sold it to Handy, the parent, would have booked tax expense on this and likely paid out taxes. So from the consolidated perspective, we would look at that as a prepaid tax. So consider deferred taxes just as being a prepaid tax because the sub dandy would have already paid tax on the profit that they booked. So to the consolidated entity, because they can't recognize the tax, they would say any tax that's been paid by the sub is prepaid to the consolidated entity. So we're going to set up our deferred tax asset. Now going back to our problem, let's deal with the depreciation. Now in this case, the authors have chosen to keep the depreciation calculations on the amortizable or depreciable fixed assets in with the intercompany profits. But again, it's the same setup, so that's okay to do that. We have a before tax, a tax, and an after tax column. Now we know that at the time, now, and don't forget, by the way, in this question, it was the parent selling to the sub. At the time that the parent sold the equipment to the sub, there was a $200 profit that was booked on that. Okay, so Handy was selling and booked a profit. Don't forget, that was in year 2 that happened. So now here we are at the end of year 6. So how much profit would have been recognized by reducing depreciation into consolidated net income? Well, we would have recognized profit in previous years in consolidated income in year 2, 3, 4, and 5. And that's 4 years because here we are in year 6 and we are recognizing 1 more year. So this would have been what we booked from year 2 all the way to year 5, $100, right? Of that 200, and then we would have booked another 25 because don't forget we're recognizing in pre-tax income $200 profit over the useful life of the equipment, which is 8 years. So 200 divided by 8 is 25 a year. For 4 years, that's 100. So we've got 100 booked into pre-tax income already, and now we only are booking another 25 this year. So that means at the end of year 6, we have 75 pre-tax unrecognized, but we can book that into the remaining years, the remaining 3 years, years 7, 8, and 9, at $45 to adjust our consolidated net income. But we're not going to make that adjustment now to consolidated income. All we're doing in the current year is we're going to recognize 25 pre-tax and $15 after tax. All right, so if you want to focus, first of all, on what the entry would be on the consolidation worksheet under the cost basis, because that's what we're using, so we would make a worksheet entry to adjust our pre-tax account to recognize $25 in pre-tax profit and also to adjust for tax expense. Together, those two would recognize $15 in consolidated net income. So we would be recognizing pre-tax profit of 25 of that original 200, booking tax expense on what we book into profit, pre-tax, and then recognizing in consolidated net income an increase in it, which is $15 from a consolidated perspective. So if you think about the worksheet entries on the elimination side, we would be reducing the depreciation expense in the given year to take the gain 200 divided by 8, which is 25 a year pre-tax, into income. So we reduce the depreciation expense and we reduce the accumulated depreciation by 25 in order to take it into income pre-tax. But then we have to pay 40% or have to set up 40% tax expense on that. So we would be setting up our income tax expense and we would credit our deferred income tax by $10, which is 40% of this pre-tax amount. Together, this credit to expense, which reduces expense, and this debit to expense, which increases expense, at net, these two guys increase income by 15, which is exactly what we said we wanted it to do. Recognize 15 into consolidated income. So now, you guys can review. This is just a summary of all of the intercompany items and deferred taxes on them from the schedule above, you can see, but I'll let you review that. I want to now get into the calculation of consolidated net income because one of the things they asked us to do in this case was to prepare a consolidated income statement. So we want to make sure that you're okay calculating your consolidated net income. So what we would do is we would start with the separate entity income. We'd start with the separate entity income of the parent, Handy, which is $1,760. We've got this in our financial statements given to us in the question. And that's in year 6. Now, because Handy records its investment on the cost basis, we do have to deduct any intercompany dividends that Handy would have booked in its separate entity income of $1,760 from Dandy, the sub. And we know that they got Dandy, the sub, declared dividends of $800. 70% of that dividend would have gone to the parent, Handy, because they own 70% of the sub. So that means that $560 of this $1,760 is intercompany dividend. So now we've got $1,200, to which we add into income our realized gain on the equipment. So now we have adjusted income of $1,215. To that, we would make adjustments for our profits. Remember, we said that we could recognize this year after-tax profit as a result of a year 5 sale, which left us with profit in opening inventory. This year, year 6, we can recognize it as $480 after tax. So again, if you go back to your eliminating entries, these two entries combined are what brings the profits up in year 6. We're increasing a tax expense because we're booking $800 in pre-tax profit. So together, this shifts into income in year 6, $480. So we're shifting it out of the opening balance to begin year 6, out of retained earnings, and into year 6 income. So that's what we're doing here. So we're taking that in, but we're also remembering that we have to amortize the acquisition differential this year. So that comes from your earlier step that we did here. We said that in year 6, we would have to adjust our income by $120 downward, the sub's income, in order to account for the acquisition differential that got amortized this year. And we also have to remember that we did have in our closing inventory a profit. So this after-tax profit of $600 is what we have to remove from Dandy's separate entity income, because don't forget, it was Dandy that sold the inventory to the parent, Handy. Handy couldn't unload it all, and that meant that we had a $600 after-tax profit sitting in ending inventory. You remember that from our analysis up here. There was $2,500 worth of inventory in the parent's ending inventory that was packing 40% profit. So before tax, we had profit sitting in ending inventory of $1,000 on an after-tax basis, $600. So that's what we're removing from Dandy's income, because Dandy was the seller. We're removing it from their income so that we can properly calculate and only have an income, those profits that the consolidated entity can recognize. So as a result, we're going to calculate, or we've calculated, adjusted income of the sub, Dandy, at $780, added to the parent's adjusted income would give us $1,995. To do the attribution, we would take all of the parent's adjusted income plus our share, which is 70% of the parent or the sub's adjusted income, and that will give us $1,761. So I'm just doing a little bit of math here with you. Okay, and that should give us $1,761. And obviously the other $780 that we didn't pick up here, because we only pick up 70%, NCI gets allocated the rest, and that's $234, and that will give us $1,995. So we've done our calculation of consolidated net income, and we use this as a check so that when we do our income statement, because that's what we're asked to do, then we can make sure that we're getting $1,995 as consolidated net income. All right, so we need to make sure that we get that number. So this is just a quick way to check. And what we're going to do in the next video is to complete our preparation of the consolidated income statement.